Hey, hello everybody. Welcome to today's workshop. My name is Jason Hamilton. I'm a certified financial planner and the founder of Keep It Simple Financial Planning and the admin of the Retirement Coach group here. So I want to be the first one to welcome you today and hope you're having a good day. For those of you that are in the Midwest, especially around Texas, I want to send a prayer out to you. And I really hope things are starting to turn a corner for you and maybe you have power back on and you're not continuing to suffer. I've talked to quite a few of our clients this week, and I had about 4 meetings canceled just because people were in inclement weather. So hopefully things have taken a turn for you, and you're getting warmed back up, and you have access to food and water because it's definitely not a good situation out there this week. So if you are watching from that area, please know that our prayers are with you, and that we hope that things are getting better for you quickly. For those of you that are new here, I want to welcome you and let you know that generally every Sunday around this time, we're going to have a workshop of some sort that's going to be bringing you some more knowledge around retirement and retirement planning. And we're in our series now where we're going to be talking about taxation in retirement. This is one area that I think is really important that I think many people underestimate the impact it can have on their finances by getting someone in your corner that actually knows what they're doing when it comes to financial planning and tax planning. There's been quite a few discussions in the last couple of weeks of, should I get a financial advisor or should I do things on my own? And I think a lot of people don't really understand what the impact or really the comprehensive services that a good financial advisor provides. On that same note, I do know that most people are just going to want to help you with your investments, and that's pretty much it. So for those of you that are doing things on their own, and it's, if you went to go speak to an advisor and all you're getting is help with investments, then you might be able to do that on your own. But there are many areas of your finances, especially around tax implications of different things like distributions from certain accounts, timing on distributions, account order, investment placement when it comes to different places to hold different types of investments. So there's a lot more to this when you're getting into the real technical aspects of retirement planning. So I do recommend a professional. And I do recommend that you work with somebody at least to get your initial plan in place and then see what sort of impact or what sort of assistance you might need beyond that. But, there's some folks that just want to do things on their own, and that's okay. But I do challenge you to consider what you could miss and what it could cost you if that were to be the case. So as we're diving in today, if you do have a question, there's a new feature here that apparently I cannot quite see exactly, what's going on if there's things like comments and things like that. So I'm going to see if I can get this up here for you, that if you want to ask a question, since I'm unable to see your comments here, let me see if I can actually get, there's something up here where you can actually put in your info so I can see your comments. So I'm not seeing it come up here. I might have to find that in just a second. But if you have a question or comment, just please put those in the comment section along the way, and I'll do my best to answer those before we wrap up for today. And, do what I can to try to make things any more clear than than it may or may not be at the moment. So happy to answer any questions and see what I can do to help you out. Let's see here, window comments. There we go. Okay, so if you have comments, go ahead and put them in the comment section, and I'll do my best to answer those. And then I will post a link here. Yes, that should hopefully answer that there. Okay, good. So if you have comments, go and put them in. If you have questions, we'll answer those. But I want to jump into today's training. So today we're going to be talking about HSAs or health savings accounts. And we're going to talk about distributions from them because that's where the tax implications are going to come in, right? So we're talking about the tax planning in retirement and tax implications in retirement. So when you take money out of your HSA, generally it's going to be a tax-free consequence, but not always. And there are some things here and there's some intricacies that I want to go through. And I want to show you kind of a workflow of how we help clients make these decisions when we're working with them. Not only do we like to keep things simple, we also like to keep things consistent. So we have a lot of workflows and processes to make sure you're getting good information and good advice when you are working with us. So let's jump into that today and dive right in and talk about our particular subject, which is will my HSA distribution be tax and penalty free? Okay, so HSA distributions, here's the thing is like, you don't always want to take money from your HSA right away to pay for things like medical expenses. That can actually be a mistake to take it too early because there are some advantages of using your HSA and then paying out of pocket today and then potentially waiting until a little bit later. So we're going to talk about that. But there's quite a bit here to cover, so I want to jump in. But before we do, I have to let you know that everything we talk about today is meant to be informational. Okay, this is educational, informational. It's not meant to be individual advice. There's no legal, tax, accounting, or financial advice being given here today. This is for information, and I do recommend you get with a qualified advisor when it comes to making decisions, especially around anything that has to do with any sort of tax implication or investment process. Okay. So I want to talk a little bit about what HSA is and a couple other benefits of them, and then we'll jump into an example or a few examples of the workflow that you might want to walk through if you are looking at distributing from your HSA and you're wondering if it's going to be tax-free. Okay, so what is a HSA or health savings account? Essentially, HSAs are tax advantage savings accounts that are designed to help people who have high deductible health plans pay for out-of-pocket expenses. So you really have to have a high deductible health plan, and this is a requirement. Now, there are some benefits to those and some downsides, but that is one of the requirements. And while HSAs have been around since 2004, very few eligible people are actually taking advantage of them. There are millions of people that qualify for these accounts, but actually don't put any money in. And the ones that do put money in actually keep their balances very low. And so HSAs are a super important account. Like when I'm talking with some people, especially younger folks, HSAs might be the most valuable account you could possibly have because they're even better than Roth IRAs in some circumstances. So we're going to talk about some benefits of them here. So here's some key facts. The high deductible health plan you need to qualify for an HSA account, it may be more budget friendly than it seems because premiums are so low. So the good thing with HSA accounts is that your monthly premium is going to stay lower. So for those of you that are self-employed or early retirees, retire before Medicare, for example, before 65 and you qualify, HSA qualified accounts could be a really nice place to put some of this extra money you might have, but you're also going to have higher deductible, okay? So that's part of the downside. If you're working for a company, the HSA qualified plan may have a larger deductible that you might have to pay before your health insurance kicks in. So you really want to look at the cost analysis and the break-even analysis to see when that might be. For example, when I was working for a company, I haven't worked for a company for a while here, being self-employed now, but when I was, the HSA qualified plan had a $2,400 deductible, okay? But it was $200 less per month for health insurance. So the way I looked at that was it would take me exactly 12 months of saving $200 to break even on the HSA account. So what I did was when I first started was instead of paying my normal insurance, I switched over to the HSA. I saved $200 per month, and then I redirected that $200 to my HSA so that that money was there whenever I needed it for healthcare. And that money's still there today. Actually, I haven't used it because I learned some of the things I'm going to talk about today, and I paid out of pocket and kept my receipts. But if something were to happen and you were worried about healthcare expense, then you may want to just direct the money immediately to the HSA and use that for that health emergency. But if you have another emergency fund set up, you might want to use that money instead. And I'll show you why in just a moment here. Okay. So this is actually a really important thing. Okay. This bullet point number 2, you can keep your receipts for any unreimbursed medical expenses and use them anytime to get tax-free funds from your HSA, even years after you incurred the expenses. Okay. So this is really important. You can pay out of pocket for any medical expenses and keep those receipts, and you can actually reimburse yourself at any time in the future, okay? So if you ever need a tax-free distribution at any point in the future, you can take this money out. And there's a couple key things you want to think about that, okay? I'll get to those in a second. But unlike a flexible spending account, so you might have heard of an FSA, which stands for flexible spending account. Those have a limit each year that you can actually roll over to the following year. And the limit for most companies is $500. So with a flexible spending account, you can generally put in about $2,500, but only $500 will roll over to the next year if you don't use those funds. And those funds are gone, by the way, if you don't use them. So HSA is a much better choice if you have the option because the money is yours forever and it is portable. So you can take that, to company and take it with you year to year. Okay. Another benefit of an HSA is you can contribute all the way until you enroll in Medicare, even if you're not working, okay? So this is interesting because you can, even if you have income from other sources, for example, or have no income at all, you can still put money into an HSA. So even if you're not working, you can contribute. That is different than an account like an IRA or a 401k. For IRAs or Roth IRAs or 401ks, you have to have earned income to contribute. So if you're at a time where maybe this last year during the coronavirus, you were receiving unemployment for the whole year because you lost your job, well, you can't contribute to an IRA or Roth IRA with that money. And I know many people that got more from unemployment than they actually needed to live, and some people more than they were earning, by the way, in the previous job. So you could technically put money to an HSA and save that for later if you did qualify and you happen to even not be working. So there's no income requirement for HSAs. And then here's the key bullet point that I want to go back to bullet point 2 that relates to that, is that you're able to invest your HSA money, and it's generally not recommended that you use it as just a simple savings account. So many people just put their money in an HSA and just leave it there and basically sitting in cash. I generally don't recommend that unless you're going to need the money in a short period of time. But in many HSA accounts, once you hit a certain amount, and for most accounts it's about $1,000, some are $2,000, you can actually start investing that money in mutual funds, right? Or in index funds or ETFs. And the huge benefit to that is if you are not, needing any sort of health care that you can't reimburse out of pocket, that money can be invested for as long as you want, essentially up until retirement and then even after. And so going back to bullet point 2, let's say you put, $3,000 or $6,000 or $7,000 into your HSA account, and let's say this year you had a $1,000 medical expense. Well, instead of taking that $1,000 out of your HSA, let's say you let your money stay into the HSA account and you invested it for the next 5 or 10 years, for example. And let's say it was 10 years, okay? And let's use the rule of 72. And what the rule of 72 is, it tells you what your interest rate needs to be for you to double the value of your account. So let's say, we talked about this last week, by the way, but let's say you have 10 years until you want to take this money out. And let's say you earn 7.2% over that 10 years, and you put in $7,000 this year. Well, if that's the case, your money's going to double in exactly 10 years. And so instead of having the $7,000, you now have $14,000. And let's say you go back to 2021 where you paid $1,000 out of your pocket. You can take that receipt out and take it out of the earnings, or really out of any money that's inside the HSA. And now because you invested the money and earned it, you technically never use your contributions, right? So you never use your contributions, and you got a tax deduction in the year you put it in. And the money grew tax deferred until later when you took it out in 10 years and you reimburse yourself tax free, right? So that's called triple tax advantage. We're going to talk about that more in a second. But these are really key aspects of a HSA that are not available in other types of accounts like 401ks or IRAs. So these are really, really useful accounts that very few people are utilizing, or it's really being underutilized. According to an October 2018 report from the Employee Benefit Research Institute, about 21.4 million to 33.7 million people had HSA eligible health insurance plans. But in 2017, only 22.2 million of that number had even opened the account. Okay, so that's about maybe up to 10 million people that had the ability to open the account but never even contributed because they qualified, but they didn't open it and contribute. And this is really just a financial literacy type of thing. Most people just don't know, by the way. They're just undereducated. It's not like they don't want to. They just maybe don't know about this. So hopefully you're looking at this today. And if you do qualify, you'll go and open an account because this is a huge benefit. These types of plans are offered by about 43% of employers right now. So almost half of employers are offering this. And if you are purchasing insurance on the exchange, like healthcare.gov or your state's exchange, you want to look for an HSA qualified plan potentially, because you can have 2 silver plans, for example, that are both about the same price, but one might be HSA qualified and one might not be HSA qualified. So you really want to make sure you're getting the HSA qualified plan, because this will allow you to contribute while you're working, or even if you're not working. And if you have extra cash to put away that you would normally use to pay higher premiums on insurance if you got a non-HSA qualified plan. So for 2021, the annual allowable contribution for a single person, for an individual, is $3,600. And in 2021, for a family or those with family coverage, it's up to $7,200 per year. So if you're 55 years or older, you can put an additional $1,000 on top of those amounts as a catch-up contribution, okay? So this is very useful. Okay, so even if you don't qualify for a Roth IRA, for example, because your income's too high, you can still use an HSA and get a tax deduction. This is a hugely beneficial plan. So the EBRI also noted that people with HSA had an average of balance of $2,922 in 2016. So this is an absolute shame, okay? This account should be, equal to you. Once you get your match from your employer, you really might want to consider adding more money to this account because, one, you can get access to it if you need it for healthcare, which could be good or bad if you have bad behaviors in place. But if you have good behaviors in place and you're a good saver, having money here can be flexible for you to use for things like healthcare, but it's also going to be tax deductible today and tax-free on distribution if you need it for healthcare in the future. Whereas your 401k will be tax deductible today, but once you take it out, you're gonna have to pay tax in the future. And with the way taxes are looking, taxes may go up. And so this could be a hugely beneficial. So I really want you to consider taking advantage of an HSA if you haven't yet, and exploring the options to see if you can contribute, okay? Okay, and then, in addition to that pitiful less than $3,000 average balance, only 6% of HSA funds were even being invested. Okay, so the EBRI found that virtually no one contributes to the maximum, and then nearly everyone takes current distributions to pay for medical expenses. So what I'm trying to help you understand here is you want to think about when you're looking at your tax planning and when you're looking at your retirement planning, sometimes you have to really look at different options on how to fund and how to contribute. And this is where I go back to those conversations that we have in the group here sometimes that people say, well, I don't need a financial advisor. I just do things all on my own. Well, when I see things like this and that only 6% of HSA funds are being invested and the average account balance is about $3,000 or less, this is one of those areas that, I think most people can really benefit from getting an advisor that really understands comprehensive financial planning. And, it might cost you a little bit out of pocket, but imagine being able to put away an additional, if you're over 55, over $4,000 or even up to $8,000 per year, tax deductible today, and invest that for the next 10, 15, or 20 years, or maybe more if you're younger. This could be hugely beneficial, and you're really missing out, I think, if you're not taking advantage of this. So again, these are little things that sometimes people just don't know about, but getting somebody in your corner that's a good qualified advisor can really help you out. And so, hey folks, my parents were totally taken advantage of by an advisor. I get why people are skeptical, but if you do your research, you find somebody good, then it can really add some value to you and really put money into your pockets for the long term. So I'm biased, of course, okay, and I'm going to fully admit my bias, and we're here to help, by the way. We help people nationwide if you do need help. We have clients in many states, about 37 states. So if you need some assistance, we're happy to help you with these decisions too, okay? And then the last takeaway here before I go into a couple examples are HSAs are what are called triple tax advantage accounts, okay? So contributions are tax deductible when they go in. If you invest your money, they're going to grow tax deferred while inside the HSA, and then they become tax-free accounts when the money comes out and it's used for qualified medical expenses, okay? So this list is expanded greatly. I mean, almost everything's going to qualify for the most part when it comes to medical. They've even expanded things as long as it's recommended by, let's say, your doctor, your medical professional, things even like chiropractic care or acupuncture care, let alone any other basic medical care. So this is really, really important, and I would highly recommend you consider this, okay? So let's look at a couple examples of whether your HSA distribution would be tax and penalty free. So I'm going to run through a couple examples here. Okay, so this is a tool that we can use with clients to help them really understand, in simple terms, is the distribution going to be tax and penalty free? Okay, so we're going to do a simple one first, and then we'll go into a couple that are a little bit more technical. Okay, so the question we're going to start with: was the distribution used to pay or reimburse you for an expense to treat or prevent a physical or mental illness? So doctor visits, prescription drugs, etc., things like that. If the answer is yes, the expense is a qualified medical expense. And then the second question will be, was the qualified medical expense paid or reimbursed by any health insurance plan, or was the QME claimed as a medical expense deduction? So if it was reimbursed, did the distribution occur when the HSA owner was 65 or older or disabled? If the answer is yes, well, then sorry, the distribution will be taxable as ordinary income, but since the owner was 65 or older, it is not subject to the 20% penalty. Can anybody tell me why this distribution will actually be taxable and it will not be tax-free? Please put it in the comments if you can tell me why this distribution will be taxable and it will not be tax-free. I would love to see anybody's comments on that if you can get this. Give you just a minute for that. I'm going to reset this here. Okay, so I'm not seeing anybody answering this correctly here. So let's go back, okay? So here's the key. Was the qualified medical expense reimbursed by any health insurance plan or claimed as a medical expense deduction? So what this is telling you, I put yes here, okay? So we're not going to be able to double dip on this. So that's the key, okay? So if we go back here and we say no, and then you can say, was the qualified medical expense incurred by you or your spouse? And you say yes. And was a qualified medical expense incurred after the HSA was open? And you say yes. There's no time limit from when a distribution can be made to pay for a qualified medical expense, and the money does not need to be in HSA at the time the expense is incurred. Interesting, right? So this distribution will be tax and penalty free. So let's go back a couple steps here and ask, was the qualified medical expense incurred by a dependent who was under age 19? Actually, let's go back 2 steps here. I'm sorry. Let's go back here. Okay, so was the qualified medical expense reimbursed by any health insurance plan or claimed as a medical expense deduction? So no. Was the expense incurred by you or your spouse? Yes. And was it incurred after the HSA was open? Well, what if this was incurred after the HSA was open? But then you ask the next question, did the distribution occur when the HSA owner was 65 or older or disabled? And if the answer is yes, well, then unfortunately, it is not. This will be taxable as earned income, but not subject to the penalty. So that's the key. If it was if this was done before you're 65, then you would additionally have a 20% penalty. So the key is, was the HSA opened, and what were you over 65? Okay. So these are the types of questions you really want to run through, and to figure out if your HSA is going to be qualified or not qualified. So let's do another one here. Let me refresh this guy here. All right, good. Okay, so let's do one where the distribution was not used to treat or prevent a physical or mental illness. Okay, so the answer is no. So now we got a new question here about paying long-term care insurance premiums. So I don't know if you knew this or not, but you are able to pay some, if not all, of your long-term care insurance premiums from your HSA tax-free. So let's say it was, okay? So the amount you're able to pay from your HSA for your long-term care insurance is going to be based on your age, okay? So here we have some different sections or some different guidelines here that are going to tell you about how much you're going to be able to pay of your premium depending on what age you were. So if you're age 40 or under, it's $450 per year. If you're 41 to 50, it's $850 per year. If you're 51 to 60, it's $1,690 per year. And if you're 61 to 70, there's a big jump there, because this is when most people are going to buy long-term care insurance, by the way. You can pay up to $4,520. And if you're above 70, it's $5,640 per year. And this would qualify as a qualified medical expense. So was the QME paid or reimbursed by any health insurance plan, or was the QME claimed as a medical expense deduction? No. Was it incurred by you or your spouse? Yes. Was it incurred after the HSA was opened? Yes. There is no time limit from when a distribution can be made to pay for a qualified medical expense, and the money does not need to be in HSA at the time the expense occurred. So this distribution is tax and penalty free. So this can get really interesting if you're going to use your HSA as a tool, and especially if you're going to invest the money inside of it to reimburse yourself later down the road and keep your receipts. But as you can see, this is not always, very, very simple. And so let's do one more and try this out, because this is one that you might find interesting, especially for those of you that are retiring early. So let's say we're going to say this is no, it was not used to treat or prevent a mental illness, and it was not used to pay for long-term care. So here's another question that gets interesting. If you're age 65 or over, was the distribution used to pay for medical and health insurance premiums, not including Medicare and supplemental policies? Let's just say no. Was the distribution used to pay for COBRA or health insurance premiums when receiving unemployment compensation? This was 2020. This could be the case for a lot of people. Let's say yes. Then if that's the case, well, now we have a qualified medical expense. If it was not, the next question is, was it paid for or reimbursed by any health insurance plan or claimed as a medical expense deduction? Let's say no, and it was incurred by you and your spouse, and it was after the HSA was open. Then you're going to have the tax and penalty-free distribution. So essentially what this is saying is you're able to pay for COBRA if you are, or health insurance while you're receiving unemployment compensation. So there's some things here that are a little more tricky, that it's just not all black and white, folks. And this is why, again, I'm biased, okay? And I'm fully going to admit that I'm biased. But getting an advisor in your corner can help you walk through these types of decisions. This is just one decision or one question you might have to be dealing with. But I really do believe in the value of advice. And I really do believe that if you have someone good in your corner advising you, and you have someone that has processes that can help you make these decisions, it's going to pay off for you in the long run. So I want to take a pause here, and I'm going to answer some questions. Let's see what kind of questions have come in so far. Let's see what we got here. Okay. Okay, so the first question is, my employer requires us to have an HSA and automatically deducts money from each paycheck to add to it. Okay, so what that tells me is they probably only offer high deductible health plans, and they're trying to get you to contribute to that automatically so that you have money there and funds in there. So, maybe I don't like the control aspect, but I like the idea because I think they're doing the right thing for you in the long run by helping you put money in your HSA. But sometimes you want to control your own funds, so I can appreciate that. Okay, so here's a good question. So, but when it's taken out, doesn't it have to be for medical expenses? So if you can take out the money technically anytime you want, okay? If you take it out before 65, you're going to pay tax and that 20% penalty. But if you're 65 or older, you can take it out and just pay the taxes on it for anything you want and use it just like a traditional IRA. So technically it doesn't have to be taken out and only used for medical, but to get the tax-free aspect of it, then it will have to be a qualified medical expense, yes. So you want to do that there, okay? Good question though. So can you set up an HSA if you're retired and previous company did not have an HSA plan? So that's going to depend on your healthcare situation. So if you're paying for marketplace healthcare, for example, and you're paying out of pocket and you're using something like ACA, or something from healthcare.gov, well then if you have an HSA qualified plan, then yes, you can set up an HSA and contribute, even if your previous company did not have an HSA plan. We talked about that one in the first couple slides there. Good question. I think this probably came up after. I guess I answered your question. That's probably where that came from. Let's see here. Okay. You cannot contribute to an HSA if you're on Medicare, correct. If you are not on Medicare and enrolled in an HSA eligible high deductible health plan, you can indeed contribute to the HSA. Earned income is not a requirement for contribution. Yes, I agree with that. Right. Okay, so my trading, is this stock trading? That's what I'm maybe guessing. My trading last year put my income over the amount that allowed me to put money in a Roth. Assuming that I will not qualify this year again, I plan to max out the HSA in place of the Roth. Hey, not a bad idea. Let's be honest. Are pretty much all of us going to need medical expenses, or all of us going to have medical expenses at some point? I believe we probably are, right? We're humans. So at some point, our bodies wear out and they break down. We have to go see the doctor. So with the HSA, you can use that for that tax deferred and then tax deferred growth and then tax-free distributions as long as you use that for medical care. So if you're going to need that anyways, then use that as a replacement for that portion of your income savings. I think that's great. Let's see here. Does the age of a dependent get moved higher age if they're still in college? Does this not follow the age 26 under ACA? Not really sure I understand that question. So if they're still in college, so it's got, okay. So I see this case. So I think this would be based on whose medical insurance plan are they on, right? So if they're on your medical insurance plan, then they're probably going to be able to qualify because then you have the family contribution amount. And so then you can use it if it's for someone in your family, then you could use the HSA for that. So I think that's what you're asking, but not 100% sure on that one. Do I think that in the future they will allow you to use an HSA for any type of health insurance premiums? I really hope so. This is a good question, and this is something that, as citizens, that you can really get involved and advocate for, because honestly, these folks in Congress, I really believe they have no idea what goes on in the average person's life. They have their own type of health care that basically everything's covered. Especially here in California, okay, by the way, our politicians understand zero about small business. It is horrible, the things that they do and the things that they push for, and they just really have no idea what it's like to operate a small business, because they come from, type of certain businesses or, companies that they just never had to be self-employed and understand what it's like when you have to do your own health insurance plan, for example. And a direct case of that in California, California is one of the few states that you actually do not get a state tax deduction for your HSA contribution. So we get a federal tax deduction for our HSA contribution, but we have state tax as well, which is basically the highest in the nation, or top three, depending how you look at it. And we don't get a state tax deduction for my HSA contribution. So I still have to pay tax on the amount I put in my HSA in California. So that tells me, these are things that we really have to advocate for ourselves as private citizens, because I think there should be no reason why you can't use your HSA money for health insurance premiums, right? Generally, your health insurance premiums are tax deductible if you were to pay them out of pocket. So why couldn't you use your HSA? It's just one of those little things that it's just silly that I think we really should be able to do that. So, but good question. All right. Let's see here. This one, I have no idea. So can HSA be used for health uses overseas if we're to retire overseas? I really don't know. That's a good question though. So I'm not sure. So, but there's things I know and there's things I don't know. And I definitely want to admit when I don't know things. So folks, that's what I have for you today. I do want to invite you, if you would like to get help with your retirement or retirement planning situation, you want to get help from a team that understands, really how to process things step by step to help you make good retirement decisions, then I'd love to invite you to a complimentary call to discuss your situation. On these calls, we generally are going to help you map out what's working, what are some things you should be doing, and we're going to give you a game plan of the things that we think you should take care of. And there's no cost for the call. But if you want to take care of those things on your own that we recommend, then more power to you. But if there's things that might need additional help and you want to get our help, we can do that too. They're no high pressure. There's nothing to sell you. It's really just about learning about your situation and really helping you break down what are the things you're doing well, what do you need to do to make sure you transition to retirement comfortably. And if you want our help, we can talk about that. But if not, then that's okay too. So we have a lot of positive feedback on our initial consultation process, and we have many people that work with us and definitely some that don't. So don't be afraid. Schedule a call if you want to discuss, and I'm happy to speak with you about this. We really like giving back to the community, and if it's something that needs our help, then great. We can work together, and if not, then that's okay, like I said. So I will wish you the best. And for those of you in the Midwest, please, hopefully you're staying warm, staying healthy, and you have food. And if not, folks, if you have other neighbors or friends that are not doing well right now, they don't have food, the stores are out, do what you can to help them. This is a time to come together in community. And it's also one of the times where I feel very grateful and blessed to be in somewhere, like California, even though a lot of the taxes are horrible here and the laws are horrible for small business owners. But on a day-to-day basis, we don't really get these kind of crazy weather things. So, we pay for that, I guess. So, but I love you all. I appreciate you watching today. And I hope you have a wonderful week. And then, please check out as well the couple posts I made. There's some new sections here that they've updated. One is called Guides, and one is called that has files in it. And I've added some more useful information for you there. Okay, so actually, before we wrap up today, since I have a few of you on, let's just go over this real quick because I want to show you this. I think it'll be good for you. In our Facebook group here. If you're watching this from somewhere else, because I'm going to usually post this after the fact. If you want to join our Facebook group, it's called Your Retirement Coach, and you can join. It is free. And so these are things that you really might want to take advantage of if you're watching somewhere else. Okay, so let me pull this up for you folks here because I think this is good. All right, so let's share my screen here. Okay, so if you can go inside our group here, there's a new section here called Guides, and I've updated this. Okay, so there's a lot of all the videos that I do on a weekly basis get put in here somewhere generally. A lot of them are under this financial education one, but there's some here like getting ready for retirement. There's some here about how to find a fiduciary advisor. So really good information here. Again, we would love for you to work with us, but if not, then at least I'm going to help you get to the right place, okay? And hopefully avoid you getting ripped off. We have some videos about healthcare, navigating healthcare options in retirement, marketplace versus private plans, long-term care, how to find affordable health insurance in retirement, a lot of things around retirement planning. a lot of videos around Social Security, and even some videos around annuities and estate planning. So a lot of good stuff in there. So again, please take advantage of this stuff. It's there for you. It's no cost. We appreciate you being here. And if you have questions, don't hesitate to reach out, okay? Have a great week, folks, and I'll see you next time, all right? Bye-bye now.